So accounting policies. So the different our accounting record accounting transactions will differ as per our accounting policies. So the accounting policy from one organization to another organization can be different. So it doesn't mean the rule will change. So the accounting policies normally govern how much to recognize, when, how we value the assets, and how do we recognize. For example, depreciation. You can have a different policy of charging depreciation in 10 years for same car, depend on some other company who may charge for 5 years, or another company who may charge for 20 years. So accounting profit for all the three companies will be different. Irrespective their operational capacities and everything else remain the same, the net profit will be different, right? So to be able to compare between two different companies, you need to make sure that the accounting policy they follow is same. If they don't follow the same accounting policy, you will not be able to compare and two different companies. Or if let's say you change the company policy for this year, then you cannot compare previous year income and expense anymore, because that will be different. So the how it different accounting policies can be different in revenue recognition. So how you recognize your revenue. So there are different ways the companies can recognize their revenue. Let's say for example a hotel. Hotel normally charge you the service charge, service money, right? So the hotel, two different hotels can have different accounting policy. One hotel will say, okay, whatever is my income only, I will record. Let's say you have a bill of $100, then the hotel will charge you 10% service money, right? And that becomes 110. And the government say there will be some $5 as a government tax. So total become 115. So the one hotel can say, okay, government tax we don't recognize as an income anyways, because that we have to pay to the government, but service charge is we collect, so we will recognize 110 as our income. Another hotel can say, hey, the 10 is actually for the staff, that doesn't money, that money doesn't belong to us, so means we will record only 100. So same operating performance, revenue will be different. Expense, when it comes to expense, the hotel which recorded income as service charge, because they pay to the service, they pay to the staff, they will record as an expense also. But the hotel which we does not record the service charge as an income, they will not record any expense, correct? So it means a different revenue recognition. So profit will be the same, but revenue and expense are different. Take another example. Let's say you are buying and selling. So you buy anything from let's say again because laptop is in front of me, so naturally I use this. So let's say you buy from the market and sell to somebody else. So you have two choices. One is you record the full value. Let's say you buy this for 1,000 and you sell for 1,500. So you can record 1,500 as your sale, 1,000 as cost of sale. Another company on the other hand can say, hey, I don't want to record the whole. I want to record only my profit. Because I pay 1,000, I charge 1,500, 500 is my income. So I will record 500 as my sale. So the accounting policies can be different based on the how they structure the contract. If let's say you buy the laptop, keep in your pocket for a long period of time and then sell it, then it becomes your cost and sale. But if you are waiting for customer to tell you, okay, where you should buy, what kind of laptop, then you are going and buying, means you are not taking any risk, right? So in that case you can recognize only the difference as your sale. So a revenue recognition, inventory valuation. Inventory is, your inventories can be valued differently. There are different valuation policies we gonna learn in bit. And depreciation method, how we charge the depreciation. Fixed asset, we gonna recognize all our spending as fixed asset, or we gonna recognize only some as a fixed asset. So you may say if I have spending anything above $100, that will be my asset. Anything I spend less than $100, that is my expense, no matter what is the life of the asset. So you can have a different policy. So the companies with different policy will show different accounting results, different profit results, right? So you need to understand your accounting policy, and craft your own accounting policy as per your business requirements. If you want to focus on every single item as an asset, you can say, okay, no debit, no fixed, no floor limit for amount. Whatever we buy more than 1 year is going to be charged as an asset, even if it's $10 or $20, correct? But if you say, I don't want to focus on the small amount, anything I buy beyond $1,000 is going to be my asset. Anything below $1,000 is all expense. Doesn't matter what is the life of the asset, correct? So the companies they need to decide at the outset what is the policy they want to follow. But policy is something which is very important to decide in the beginning, because you cannot change it every year. The policies are not supposed to change every year. You can change it only once you are required to change materially impact. And whenever you change, the normally financial statements require a lot of disclosures, especially if you follow IFRS or any other recognized international accounting standards. Whenever you change a policy, you have to do a lot of disclosures, so that may be painful. So select your policy carefully. Okay, so we're gonna